Thank you. I want to give you a little bit of introduction on today's topic. Payment infrastructure is transforming as traditional and blockchain networks converge. Recent moves by leading tokenization firms signal a shift in cross-border transactions from legacy rails to digital assets. This panel will examine how these changes will transform B2B payments, enhance efficiencies, and establish new benchmarks in global financial flows. My name is Kavi Harilela. I'll be your moderator. I'm from Payment Asia, and I'd like to introduce you to my panel and give them time to introduce themselves. Kelvin, would you like to go first?
Sure. Hey everybody, I'm Kevin, one of two co-founders here at Reap. I'm normally based in Singapore, but I lived in Hong Kong for 5 years between the years of 2015 and 2020, which is where we actually started the company. Reap is a global financial infrastructure fintech player focusing on delivering financial access and inclusivity via the capabilities that we power to fintechs, neobanks, other embedded finance capabilities around the world. We specifically focus today on card issuance and the cross-border money movement, leveraging stablecoin technology to power such infrastructure.
Daniel?
Hi, I'm head of Web3 for Banking Circle. We are a bank based in Europe, and we also have a presence now in Asia. We also have a bank in Australia, and we have offices in various places in Asia as well. We are the first bank in Europe that have actually issued a MiCA compliant stablecoin. And on top of that, we also issued a tokenized deposit. So that tokenized deposit is being used by Ant Group. As a bank, we clear more than $1 trillion euros of currencies per year. And we bank for about 700 institutions, which are largely payment companies and also other banks.
And Yamki.
Hey everybody, my name is Yamki Chan. I head up APAC for Circle. Circle is a publicly listed company on the New York Stock Exchange. We are a global fintech platform that includes everything from blockchains all the way up through tokenized money to various Web3 related products. We're probably most well known for USDC, which we're the issuer of. It's around 76 billion in circulation. And since the beginning until end of September 2025, there's been about $40.5 trillion of on-chain transactions using USDC.
Thank you very much for your introduction. Now, I have a general question for all of you. This panel represents the entire modern payment flow. I want to ask all of you, from your own perspective, which part has the most challenges in the modern payment flow? Would you like to go first, Yamki?
Sure. Where do I start? Sometimes when you are so used to how things work, it's hard to imagine the cost that you have to bear in the existing system versus something different. So imagine if your entire life you've driven a petrol car. It's hard to imagine what life is like in an electric vehicle where you can go much faster and you have lower maintenance costs. So a part of thinking about the payments part of the business is that we, all of us, whether it's individuals, SMEs, even large enterprises, are constantly dealing with the hidden cost of money, hidden cost of payments, where the money that you send takes longer than you thought it's going to get there. There is a lack of certainty of when it arrives. There's constant checking. And then there's SOAs on when it actually does arrive. And this gets particularly challenging on cross-border and in particular in emerging markets. And this is where I believe the Web3 and tokenized money becomes a really helpful way to solve.
And Kevin?
Yeah, so we look at it in a fairly similar way, but we focus on where the pain point's the biggest, right? And to Yamki's point, in some cases where there are established payment systems and it's functioning relatively well, maybe the pain point is not high enough, right? People are okay with just good enough. But in terms of where we serve, we're trying to connect the most disparate economies, the places that have the access, least access to financial infrastructure and the capabilities that we here in Hong Kong and Singapore, in financial hubs of the world, enjoy on a regular daily basis. So for us, it's thinking about where are those endpoints, and specifically that's focusing on emerging markets and connecting them to the capabilities that we have here today, and exporting those capabilities via tokenized economy, stablecoin, and blockchain technology to give them that access.
And Daniel?
Yeah, I think one of the issues is that stable coins are very new, and it's operating in an environment that is governed by legacy systems, right? So I give you an example. In Europe, a stable coin that is single currency backed is deemed as an e-money token. So you would think that an e-money token can be actually used by any crypto asset service provider, and I can transfer it. But because it's deemed as an e-money token, it has, when you transfer it, you need to have a payment services company to do it, because that transfer is governed under an old rule, PSD2, Payment Services Directive. So a CAS can't do it by itself, and it needs to rely on someone else. So there's a lot of all these teething issues that's coming up. So as new regulation comes about, you will see all this kind of issues coming. I mean, the other thing is that you see that there are things like, you hear about stablecoin sandwich. Stablecoin can do some sort of transfer, but in between, they're only doing the in between. On both ends, there is still reliance on some sort of financial institution. So it's like, let's say, for example, the whole idea of a stablecoin is, if I want to transfer something to Yamkey now, I transfer the Yamkey, he just goes there. There's no intermediary in between, and he gets it, and that's the end of it. But the fact is that a lot of people still work with fiat in, fiat out. So there is always something happens. I'll give you an example. If I want to transfer something from Europe all the way to the US, so someone gives me euros, I FX it to US dollar, I go and buy USDC, and I transfer it to the US, and I'm going to give it to Kevin, right? So, but because Kevin wants actually the US dollar, he doesn't want that stable coin. So then I'll say, Yamkey, can you burn it? Yeah, Yamkey burns it. And then I'm going to say, can you send it to Kevin? He says, I can't do third-party payment. I have to send it back to you, right? So if I'm not a bank in the US, then I would then have to rely on my correspondent bank in the US, right? I go back to the traditional vostro-nostro model to hold that and then transfer it to him. So because of all those traditional legacy system, it causes a lot of all this kind of friction that actually does not need to be.
Very interesting insights. Coming from the payment world itself, being a payment Asia, yes, we noticed this. Great point, Daniel, because it is very big insight to see how you say sandwich it, because you still need someone on either end to essentially give the utilization of it. Let me take you to the next question. Daniel, straight to you. How effective is on-chain FX using stable coins, and if this would replace traditional FX markets?
Okay, so I think there is actually a lot of efficiency for it. It's just that there's not enough currencies outside of the US dollar stablecoin to make this very efficient. But it's something that you can see that is very efficient. But I think it would take some time. So roughly, on-chain FX, using stablecoin transfer is roughly about 3.5 trillion per month. You compare that to traditional FX, that's at least 7.5 trillion US dollar per day. So it's many multiples, right? So the FX market is far, far bigger. And what the FX market is really used to is this settlement system called PVP, payment versus payment. They use these systems. Anyone in the FX, you will know CLS, continuous link settlement. So what happens is basically you have sort of it's an intermediated trade to ensure that both counterparty would pay up and that there's no failure. And it's shown to be relatively resilient. Even in the Lehman crisis, the CLS held up quite well, right? But the thing is that in stable coins, when it comes to doing an FX transaction, you actually technically do not need something like a CLS. It's just that a lot of people in the traditional space do not understand that. They are so used to this intermediated trade that they don't understand fully how to do this. So in stablecoin, if you do an atomic settlement, so if I'm going to do, I have a euro stablecoin now, and I'm going to FX it with Yamki. So I'm going to send euro to him, and Yamki is going to send me USDC. So now the problem is that what if he sends me USDC and I don't give him the euro stablecoin, right? So what you can do is that you can ensure this using a smart contract for atomic settlement. So in atomic settlement, what happens is that when I send it, it's only on delivery versus payment. It's swapped instantly. So by doing that instant swap, I don't need it to be intermediated. I don't need something like CLS standing in the middle. But this is something that's still quite in its infancy. The systems has not been built up yet. Most FX traders are not used to it. So it would take time. But there are many projects that are working towards this kind of thing. Like for example, there was this project called Better Payment Systems, and they're trying to do on-chain FX on the Better Payment Network, I think it's called. It's trying to do on-chain FX on DeFi, and they're trying to do all these kind of swaps on it. So these are the kind of things that you see different projects trying to set up that solution, but it would take time for mainstream FX people to sort of adopt it.
So maybe just a quick add-on to that. I think one of the things that we see very often as a payment infrastructure provider is that we think about the FX and currency pairs, right? And in the traditional world, it's fiat against fiat. So I think today that the problems that we are seeing, or at least with our customers that we're serving, is that there's still not a stablecoin to stablecoin kind of equivalent. I mean, US dollar stablecoins have done quite well, but on the other side of that pair, where is that stablecoin equivalent for whatever you're trying to transfer into? And I feel like we haven't seen enough of that, which is why the current way that we operate is oftentimes taking a US dollar stablecoin, turning it back into fiat, and finding the fiat to fiat pair in order to operate some of these capabilities. But what I am excited about is when the other side becomes on-chain and becomes tokenized. And I think that requires a few things, right? In the same way that US dollar stablecoins, such as USDC has done for US dollars, you need to create an issuer that has trust. You need to have create an issuer that can have liquidity and interoperability so that you can switch back very instantaneously. You're effectively mirroring the fiat currency. And once that happens, you're able to then create the stablecoin to stablecoin FX pairs that would allow us to facilitate this on-chain economy a lot easier.
First, I like the fact that all of the example is Daniel sending me money, so keep it coming. Second of all, I think I want to build on this point around the other side of the trade. We actually launched or announced the ARC testnet. It's our first layer 1 blockchain. And as part of their announcement, at the very, very top of that, we actually mentioned a couple of other stablecoins or tokenized money. I think that's the term of the jour, for different currencies, whether it's Korean won, Filipino pesos, and others. And we're working with various firms to see how we actually bring this live. But it is early days, and it's going to be quite interesting where today there's this quote-unquote stablecoin sandwich or open sandwich where one end is fiat or both ends are fiat with stablecoin in the middle. In the future, I can expect that some of this will have different types of stablecoins or swaps between stablecoins along the way.
Highlighting on that, and for anyone here, what would your concern be, or should I say, my concern would be, was the other side of the token. Yes, we have the USDT, USDC, established, big players, liquidity backed. There is those guys, but how long will it take for the other currencies to have their stablecoin that is reliable and built up?
Well, first of all, I would say not all stablecoins are created equal. We've worked very hard to ensure that for USDC, there's global liquidity and interoperability. So the ability, number one, for it to be properly regulated in a number of places is recognized in Europe, in the US, in Singapore, in Japan, and many other places. And then we have global banking partners some of whom are the names here in this conference that provide the ability for us to interact with our client directly on par one-to-one. That's really, really important. And then with various market makers, OTCs, and distribution partners. So number one, I think it is really difficult to build a properly regulated, globally interoperable, trusted stablecoin. Now, what it does do is that, similar to the TradFi world, the traditional finance world, a well-regulated dollar stablecoin can actually become a infrastructure or backbone to various other currencies. Oftentimes, when you're going from Vietnamese dong to, say, Thai baht, rarely do you go directly. You have to, generally speaking, reference the USD because that is the anchor point. To quote maybe the last panelist from the anchor point team. But I think that is important to think about, where when you have laws in place that set the right standard, which is happening around the world, you will have local stablecoins. They will then be able to interact with other well-regulated stablecoin, and I think we can get that beginning of that ecosystem to be built.
Actually, while I have you still on the mic, for Circle, is it more cross-chain adaptation? What's your latest update, especially across chains, institutions, or geographies?
So part of how we've built interoperability with USDC is that we're supporting almost 30 different blockchains today. So think about that. That USDC, even though you see that as a token on a blockchain, we are on Ethereum, we're on Polygon, we're on Solana, we're on Aave, lots of different chains. And that is part of our vision, our support of the ecosystem, but also the fact that different developers, different application companies have a desire to build in different ecosystems. So we're supporting them there. And then what we do is, on the back end, we have a technology called Cross-Chain Transfer Protocol, CCTP, where we can natively move these USDC tokens without using a bridge from one chain to another. So if you are a company and you happen to develop on Solana, great. But your users are using USDC in Polygon or Ethereum, there's a way for us to essentially teleport that natively without going through a bridge to be able to do that. So I think it's really important, and there will be more blockchains in the future, and we intend to support more as they come along. And of course, having Arc as another platform, another blockchain that we're supporting, will help with the interoperability across different chains as well.
Thank you. Kevin, TradeFi players begin to adopt blockchain rails for treasury flows. How do you think such dynamic will play out between established players and fintechs like yourself?
So I think for these traditional players adopting it for treasury flows is actually a very good sign for all of us, right? It really allows them to become internally consistent, comfortable, and find a set of standardization around how they want to adopt the stablecoin technology. And I think what that means is we, as the connector and kind of the software and technology layer, can plug into the various treasury systems that are then being built in order to facilitate the fund flows in between them. So I think having them recognize the capabilities from an internal treasury perspective is one of the such first steps that we all need to do as ecosystem players to drive the adoption of blockchain on the benefit side. And then from there, we can provide external value with all the things that we're doing around cross-chain interoperability and then cross-organization interoperability to bridge these gaps together.
Can I follow that up with, what may drive business to change to stablecoins or not?
I think for me, it's a cost-benefit analysis, right? I think we talk a lot about the benefits of it being more instant, more reliable, more open, more efficient, cost-wise, and as well as kind of reliability basis. But I think the other side is also just for them to understand what the costs are, right? And the costs are technology readiness in a lot of use cases. Are we ready to start embracing this technology? Because at the end of the day, there's an investment. You got to upgrade your systems to be able to be compatible. And that's why technology players such as ourselves exist here to provide that level of service and consultation and education. The other side of it is also just considering risk as a cost, right? Can I trust this technology? Are there things that I can do to ensure that there is this mirroring of worlds between my existing fiat system and what I'm about to bring onto the blockchain via stablecoins? I think a lot of the folks here, such as the issuers, the banking partners, and technology providers are all trying our very best to lower that particular risk, as well as from a regulatory perspective, right? Regulation enforces the practices that we have to put in place to lower the risk for our customers to understand what it means to adopt stablecoin treasuries.
Actually, I agree with you here. Last year myself, I was a panelist, and I think I said the same thing. I said, the technology is available. It's just the regulations, and will they come to a point where everyone's happy and comfortable to operate with this ecosystem? And I think that hasn't caught up yet, and where there's uncertainty, us fintech players do not want to go unless we have that clarity first. At least that's from my perspective, because is that technology available? It is available today.
I think it's about thinking in analogies, right? From a technical perspective, speaking as a technology company, everything that you currently do in accordance to regulation is technically capable on blockchain and the way that we transfer money. Right? You can apply AML policies, you can apply transaction monitoring capabilities. Have we done so across all different fields and kind of come to a consensus around these type of standards? Maybe there's still work to be done there yet, but from a technical feasibility perspective, it's 100% possible, and in fact, I would argue to say that you can even do more things with this technology around regulation enforcement and policy adaptation versus the traditional rails.
Yang Ki, as an issuer, how do you see the current adaptation and use case for stablecoin? Any new direction on how bridging it more into real world or TradeFi?
So, based on some of the recent reports, so Fireblocks has said 56% of institutions in Asia today are already adopting stablecoin. According to McKinsey, 20 to 30 billion dollars of transactions are happening a day using stablecoins today. So I think it's sometimes a bit silly to ask, like, what is the adoption curve? And the fact is that it's already happening. I think the challenge is that oftentimes it's in a way, like, we don't talk about getting on the internet. It just is. You abstract away all of the complexity. Companies today are moving money using stablecoins around the world. They're doing it because it's cheaper, faster, it works 24/7, and the data has proven to be the case. Now, the payments market and the money move market is much, much bigger, and there is still a lot of room to grow, but this is no longer a sort of a fringe technology that I think people are constantly asking, well, what is the use case? And then I have to ask, like, where do you use money, and how can you use money better, faster?
I think one of the reasons some adoption hasn't happened yet is because of there are rules on capital for banks, for example. So, for example, Basel requires a bank to set aside 1,250% capital charge if they're holding stable coins, right? But that's going to change in the future. So, like, Basel has already come up with a proposal called SC 060, and that's going to change how that treatment would be. And that would actually encourage even more adoption, I believe.
Daniel, can you see stablecoin settlements effectively replace traditional banking rails?
I think it would actually take some time. Because if you look at how cross-border transfer today, it's all done using a network of correspondent banking. We know that's not very efficient, there is a lot of friction and cost and stuff, but it's a system that has been set up and it's ingrained, right? So your transfers use a network of correspondent bank using SWIFT network, and all the processes on how you identify end beneficiary, how you actually do your money laundering checks and stuff like that is all already ingrained. So in order for you to change this whole system, it will take time. It will not happen overnight, but it will happen gradually. It's just that at this point in time, that is just a lot of legacy system that's holding it back. A very simple example, a payment company in Europe that wants to use a stable coin for transfer, and there's a lot of all these payment companies that want to do so. They are having issues with their own regulators because a payment company is actually a EMI, electronic money institution, or a payment service provider. They are not a crypto asset service provider in Europe, and therefore their license doesn't allow them to handle that crypto. So these are some of those legacy regulations that need to change, to enable a lot more adoption. So there is a lot of financial institution, in short, to say that they see the use case, but it's harder for them to adopt because of these legacy issues.
I would add that we need to put to rest this concept that like Web3 and banks are in competition and that you have one or the other. That's totally not the case. We work with many banks around the world, including some that are around here. And the fact is that banks do quite a bit of different function, and they're very important functions. Some of it could be more efficient, agreed, but there are certain parts of it that are irreplaceable, and we need to recognize that. And so this is not in the fintech space, we're constantly in this continuum of times and parts where we're cooperating, competing, and frankly, ironing, sharpening iron to make each other better. And I think we're seeing that. We're seeing many different banks getting into either the issuance of stablecoin or leveraging stablecoins in their business. Right? They're not shying away now that regulation is becoming clearer. At the same time, you're going to see many Web3 companies moving into the quote-unquote traditional finance space, that they're going to move into trade financing, they're going to move into tokenized equities, they're going to move into wealth tech and other things. So I don't see this as I don't see this as competition or replacement. If you look at, just look at previous technological change as an example. Streaming only recently became larger than cable TV. But cable TV has not gone away. It's lasted the last 20, 30 years, and it will continue to exist.
So I still have a job.
I was going to say, I've always held this belief, which is not very popular. I think all banks are fintechs, right? They adopt technology like anybody else, and this is not about replacing the institutions of banks themselves, but rather, can they adopt the latest technology and replace the inefficient parts of their business with that said technology? And that said technology here we're talking about is stablecoins. If you think about innovations that banks have done in the past, telegraphic transfers back when it was a thing was a technology. They took over the telecom systems to be able to send money, send messages through. All of the security features you see in paper checks, technically fintech. So I don't think this means that banks will be replaced. I actually think the lines between banks and fintechs are becoming even more blurred in the advent of this world that we're in today. So I don't agree with that statement.
Yeah. I think fintechs will become more like a neobank. They'll be able to do more, right?
Well, traditionally, smaller companies have been faster to move than the traditional banks, but the banks have eventually adopted the technology and brought it over or licensed it or used it in some form or the other, but they've not been as fast moving. As we are running out of time, I just want to ask you all to say maybe one short line on what will the global B2B payment landscape look like in 5 years from now? Each of you. Anyone can start first.
Well, I think the B2B sort of payment network is going to be a lot more regulated. And I think that regulations will not just be in the centralized space. You are going to see things that move towards, regulators will attempt to also manage unhosted wallets, and also things that is like DeFi and decentralized exchanges as well, using like whitelistings of wallets and various methods that they would have. So you will see a much safer environment to work with, and that will actually enable a lot more institution adoption.
I'd like to see more technology use cases on this new network that we're powering. Yamki mentioned streaming. That wasn't capable until we got internet fast enough to support the type of data being throughput this kind of network. I think we're kind of at that kind of turning point for payments as well, where the latest technology allows us to throughput a lot more because of efficiencies and cost gains and things of that nature. And as such, there's going to be new business models that emerge, whether in the fintech space, embedded finance, neobanks, banks that don't even look like the banks that we have today. I'm excited about that.
Certainly, the volume of B2B payments will increase. Number one, because of inflation in general, you have more dollars moving in the system. Number two is with stablecoin, the velocity of money is a lot faster. And then number three, because of de-risking globally, there's going to be more trading partners than ever before, right? That there used to be these corridors of trade that dominated the volumes. You're going to have more corridors, meaning more currencies, more actors, and then more transactions. And I'm looking forward to see how this is going to develop and how we are able to increase the system but also make it more efficient at the same time.
Thank you so much. I think we've run out of time. Will everyone please take a time to thank the panelists? And let's take a photo.
Thank you all for those game-changing insights.